the markets that these companies are operating in. And obviously, you want to have a good company run by folks you trust and all of those kind of things, and that's kind of step one. But really investing where there's a tailwind is, yes, to me the most important thing. So I spend a lot of time in areas where I feel there is growth in the end markets, not just the companies themselves. Obviously, spending a lot of time with the company to help affect an outcome is what I really enjoy doing. But it's a lot more fun in a market that's growing. And so I've been spending a lot of time in cybersecurity, AI, data science, machine learning, a lot of areas that the traditional software world has morphed into, right? I mean, if you think of enterprise software today, Snowflake, for example, it's a data science company, right? It's not really an enterprise software company as we would have thought historically. So, spending time on companies where, again, they are utilizing all of the new kind of tools available to them in a market that's growing. And so that's where, kind of step one. Obviously, our network from the public side for the last 20 years has really been beneficial on the private side because a lot of folks that we have known through our research and diligence on public companies are now running some of these successful private companies. And so that's where a lot of my ideas come from, are from kind of the network of public companies that we've built over the last 20 years.
So just to dive down a little bit more on the public side of when you're investing at Standard Pacific, so you're clearly looking for secular growth. Companies are operating within secular growing industries, rising tides, tailwinds, which I completely agree with. It can cover up a lot of mistakes and misexecution by management if there's overall the demand wind is strong there. And so how would you kind of merge that, given that is going to be a little bit more longer term, towards also performing in the shorter term for the LPs in your fund and translating what you see as kind of big picture growth areas into more near-term numbers and size and valuation?
Yeah, I guess one thing I don't do is I don't speculate on markets that don't exist yet, right? And so I see a lot of the activity today that we're seeing in early stage world is focused on areas where maybe that market doesn't really exist, and you're trying to value the accessible market 5-10 years out. That's not something that I spend any time on. I spend time on companies that have actual products that customers are paying for, right? So that's step one. So no pre-revenue companies really. I've been burned several times in my career on trying to do that. So there needs to be validation from a market in terms of product market fit before I really roll up my sleeves and get involved. And so I guess that's eliminates kind of more than half, I think, of stuff out there because there's a lot of great ideas and PowerPoint presentations that are not getting market validation, and so I just don't spend time there. And so then it really comes down to setting very specific thresholds for my management team early on, and I try to reinvest behind my winners, and guys who are having a hard time hitting their bogeys in the first year or two out of the gate are sometimes take more of your time than it's worth, and so you've got to be judicial, I guess, in terms of where you spend your time, who you spend your time with. Is I guess another lesson that I've learned the hard way. Because usually it's the guys that aren't hitting their bogeys, aren't successful, that are sucking all your time. So one of my company's inception, which is kind of in that unicorn kind of stage right now. Again, they're beating quarter on quarter, and so I found that the more time I can help them with new customers, new collaborations, new technology partners, those kind of things, they're really able to throw fuel on the fire as opposed to the guy who's trying to go from 2 customers to 3. I just that's always a tough game for someone like me who has a very small kind of shop.
Makes sense. So one of the key differences here between public investing and private investing is the most obvious. So it's liquidity. So in the public side, when we're investing entirely on that side of things, obviously trying to look to reduce mistakes, But if mistakes were made, or assumption, or the investment thesis changes, or management changes, something that was just a little bit not predictable in a traditional analytical framework, you could get out within a matter of days, if not hours and minutes.
Mhm.
So how are you going to think about what has to change in terms of the due diligence and analysis when you're faced with a much less liquid situation that you're committing capital to?
Yeah, I mean, one thing I try to do is, again, I mentioned kind of affecting an outcome. When I make an original investment, I try to bring in folks who can actually help that company get through kind of periods like that. So I just did one in the prop tech space and brought in Cushman & Wakefield as an investor with us. And that gave the company, a lot more runway from capital standpoint, but also gave a customer that can then be referenceable to a lot of other folks. And so there's things like that I try to do in my deals to just, again, provide a little bit more cushion to that kind of period of growth that, like you said, sometimes, it's things don't ever work on the cadence that the management team thinks, right? So bringing someone to the table initially to help get them over that hump is how I try to deal with that, right? Because inevitably every company is going to have a period where they're going to have a stall out in terms of customer acquisition, and so bringing those to the table is kind of what I try to do in each of my situations.
Right, and that's a super important point. I think increasingly entrepreneurs and companies are looking for not just capital from their investors, LPs. There's one thing about, obviously you have people on your board and you have people on advisory boards, but it's increasingly important that you utilize and leverage the networks of your shareholders in terms of uncovering customers, networks, partners, and the like that's kind of going along that side. Maybe it's fun, I think, for investors to hear a little bit of kind of both successes and war stories, a little bit, because obviously not everything always works out. So maybe you could run through both kind of on the back into your history on the public side, where you had something you thought was going to be a winner, didn't quite turn out, and yet maybe an example of where your process was successful, and you can do the same thing on the private side.
Gosh, oh man, that's a lot. I guess on the short side, as you and I have lamented over the years, can be tricky. I got lucky because I started covering the software industry in the kind of mid-late 90s, and the first I was at Fidelity and then joined Standard Pacific in '98. And the first job I was given was to really look at all these Y2K remediation companies. And it was, the biggest layup short you'd ever seen, but they had explosive growth in like 98, 99, and then just, hit a wall, obviously, when Y2K was over. Pretty obvious, but again, that was a painful lesson to learn, because being early is also wrong, might be wrong, right? And in this case, we had enough conviction to stick through it, and all those companies ultimately blew up, and that was kind of my first foray. And then simultaneous with that, we were spending a lot of time in India, you probably remember, and had several large private investments in companies like Infosys that then went public, and Cognizant, which became obviously pretty big companies ultimately. And that was kind of the other side of that trade, right? Those guys were, for a COBOL programmer charging $200 an hour in 1998, when, in 1995 they were getting $50 an hour. The Indian outsourcing firms were coming in at $20, $30 an hour and just cleaning their clocks. And so it was a combination of growth for these guys who were coming into the market, and the guys who had been really taking advantage of their customers because of Y2K, just getting smoked. So that was kind of an interesting way to kind of learn the software and services space. Nowadays, now also because of liquidity, as you mentioned, the short side is very difficult, because one, the market is accepting these SaaS models with very little accounting transparency. I mean, it is really difficult. Again, covering software in the 90s and early parts of 2000s, you could look at these enterprise license agreements. They were using percentage of completion accounting. there were all kinds of things you could use kind of forensic accounting and understand what was really happening and get an edge on a situation that maybe the street was missing. Nowadays, you look at the balance sheets and cash flow statements and income statements of companies, you have no idea. I mean, you know, their gross margins are negative in some cases. Like, it's like, you know, it's really impossible to get an edge on the short side except for the top line. That's all that anyone really cares about. And look, when rates are at zero, that's all that matters. When we have a normal yield curve, watch out, right? Because then all of a sudden, those little top line misses are going to be really, really painful for investors. And I don't think people appreciate how dangerous some of those situations are.
Yeah. I'll chime in a little bit on the public side where some of my bigger mistakes were, which is also probably a little bit more on the short side than anything else, was getting sometimes too focused on the operational results of a company, and particularly those that were challenged, and they add that to highly leveraged situations, so you get kind of missing numbers, declining things, and they're leveraging, and you're thinking, well, there's just no way this is not going to zero. I should focus on that. But at the same time, my strength in my career was communication services, telecom, and sometimes I lose sight of the actual value of the asset. So, you know, a spectrum position that was underutilized that a bigger company could take better value of than a company that was struggling with that. Those types of situations could turn into dangerous very quick. I mean, you also saw some companies like, there was AOL that basically acquired 50% premium for its IP, intellectual property, like a hidden asset, even though it was a declining company, or other elements along the way. And on the positive side, it was operating leverage, finding those big markets with those sector tailwinds, high fixed costs, high capital costs to start, and it usually surprises investors at how much of those profits fall towards the bottom line.
I mean, look, a good short is a company that doesn't meet expectations, period, full stop. Nothing else matters, right? So understanding what expectations really are is the art of that kind of side of the analysis. But at the end of the day, if that shorts look like they're cheap, right? I mean, shorting expensive stocks is a loser proposition, because your spreadsheet and my spreadsheet work the exact same way, right? If we're using the same data to analyze a stock or a company and expect it to go down because it's overvalued for some metric that we think, that's idiotic, right? The only thing that makes stocks go down is missing expectations. And the best shorts, I mean, in 2008, where we had a pretty good year, we were shorting stocks that, look really cheap, but the numbers were so wrong that, they weren't, right? And that's really all that matters, is understanding where expectations are. And that's true on the long side. You get away with a lot more when you have, so much liquidity in the system. And also with the ETF dynamic, you've had a lot of liquidity into the bigger cap growth companies as they get to be bigger parts of ETFs that are getting flows. It's like a fulfilling thing. That flywheel goes the other way, and it'll be problematic for the market. But again, not until rates go up does that matter. Yeah.
Well, great. Well, let's go back to the private side. Since obviously, this is where a lot of the attendees of this conference are most interested in. Yeah. And you and I have talked some about some of the companies in your portfolio, super interesting markets and growth areas. Maybe you can pick out a couple of them that you'd like to talk about maybe what drew you to them, where they are in their life cycle, and maybe if we might at some point have an opportunity to see some of these companies on the LinkedIn platform.
Sure. I mean, again, I've never worked with the LinkedIn kind of platform in that way, but like I said, cybersecurity is an area I spent a lot of time in. Telos, which has been in my portfolio for 13 years, went public in November, a great company. I think that area is really interesting. So there's a couple of companies in my portfolio. Paravision.ai is one, where it's a computer vision company that I think will have a lot of traction in the next few years. And there's some great partners with the biggest players in access controls and identity and those kind of areas. Inception, I mentioned earlier, is one that I think is probably closest to an event. And again, Inception, think of it as a Shopify for B2B. And again, one thing that drew me to this company was the just unlimited TAM. It is a massive market. They are providing small, medium-sized companies logistics, really, help to get from point A to point B. So think of it as going into these companies, helping them solve their biggest pain point, which is freight logistics, and saving them money, and then being able to sell basically any other service to that financial service or other product to that universe, which that every company is trying to get to, right? Small, medium-sized enterprises are very difficult to acquire as customers. And so, Inception's been acquiring 200 to 300 customers a month, is going to be doing kind of run rate of 200 million revenue, kind of by the third quarter of this year. So it's becoming a, real sizable company, and it's really interesting just in terms of what they can do. And again, what I think is interesting is being able to introduce them to other companies in my portfolio, cyber insurance companies that are trying to get into that small and medium-sized enterprise, so that they can use them as a channel to sell their product to that to that group, which is fascinating to watch. So again, company with massive TAM, growing really fast, but also an area where we can help them kind of accelerate.
Yeah, I sort of appreciate that you pointed out cracking the code on selling to small, medium-sized businesses. Being again, a telecom analyst for 2 decades, saw a lot of alternative telecom companies die on the vine with the churn and the bad debt rates in trying to crack that, and it's there's not a lot of efficiencies there. So if you can get a channel where you can access that market, it's usually big and so underserved by the large companies. Definitely see that as a great investment thesis. One last topic I wanted to get with Doug, and then we can maybe field a question or two. Is Doug has a really unique seat, and just about his ability to kind of execute on this. Whereas after he was done investing on the public side, and they closed the fund down, one of the portfolio companies invited him to be on the board of the company. The company is Acuity, that he's been on that board for a couple of years. And so as an investment professional, essentially being on a public equity board is not that common, believe it or not. And I mean, there is obviously a lot of historical private VCs that graduate as a company becomes public, but making that transition is not that common. And then obviously Doug's been involved on the board of some of the companies in his portfolio. So I thought maybe if you could just kind of briefly, rather than so much talking about those specific companies or what happened, just kind of the difference between the experience of sitting on a public board and sitting on a private board or startup board, and the skill set you think the board members need to bring to create value in both cases.
Boy, gosh, the skill sets are really similar, to be honest. I mean, with Acuity, which is traditionally a lighting company that is transitioning into a technology, IoT, data science kind of company or opportunity, and with a new CEO and all of that, it's been a really fun, interesting company to be a part of. And so again, that is understanding kind of where that company is going, helping them think about strategy at a really high level is interesting. And on the public side, one reason I was asked to join that board is I was not shy to give them my opinions on what I thought they should be doing as I was a shareholder. And so when I returned capital, CEO said, "Well, so smart, why don't you come join the board and help us?" And so that's been an interesting process. The private companies are much more tactical, right? It's much more, okay, how do we get, we want to get this customer, or we want to get this relationship. How do we do that? And how can you help us? Who can you help us get to make that happen? So it's a little more in the weeds for the most part. Those really good startup companies that are transitioning, like an Inception, for example, is gone from very tactical to now very strategic in terms of where I get involved as an advisor. FaZe Clan, which is a gaming company of mine down in LA, again, both, right? Tactical, strategic, like it's drinking out of a fire hydrant every day. So it just depends on the company. Telos, again, which went public in November, has a very professional management team, very much a strategic, kind of thoughtful leadership team. And so again, helping them as a board member was much different. So they're all so different. But the public stuff is different because there's a lot of structure around what you're doing. It's not as much CEO calling me late at night and asking me to help. It's much more structured.
Yeah, that really makes sense. That's great. Kareem, throw it back to you if there's any questions from you or the audience?
Yeah, we had a couple of questions, but let me first thank you, Stephen and Doug, for this wonderful opportunity. I think the salient points I'm picking up from this, and I think some of our audience, whether they heard it or not, was very, very important. It's about balance. It's about understanding a little bit about who you are and what you want to do, and then knowing that all the spreadsheets are the same, the results will be the results, which was a great quote. I think if I can remember it, I will use that. No, thank you, Stephen. Thank you, Doug. I appreciate the efforts here today to help us understand private, public, the choices that we make, and understand where we have strengths and to follow with those strengths to be successful. So I appreciate that. You know, if you have a couple of closing statements, that's fine, because we now are moving on to the public sector, where we have some millennials who talk about what they do in the public markets and solely on the public markets. And this would be interesting for you to stay on and listen to as well.
Yeah, teach the old dogs some new tricks, right?
Yes.
Doug and I are going to feel like the old dogs. Yeah, no, I think that's right. I think it's ultimately, and in my investing career, you know, you have to deal with numbers, you have to deal with professional management teams, and you have to stay with a discipline over emotion. I think, you know, and it'll be interesting with the next panelist. You know, there's a lot of FOMO investing out there right now, right? And generally, I'm sure Doug will probably agree, you get a little bit over in love with a management team or over in love with a product or something, and it starts to you start to make excuses for, you know, what's actually happening or where things are missing can be mistakes. So you do have to stay with, you know, discipline. Go back to original investment theses. When thesis drift starts to happen, that's something we talked about a lot. You know, this thesis drift is something that you want to make sure at least raises a little alarm bell in your mind as an investor.
Yeah.
And how to either say, okay, is this genuinely better, or is this different because, you know, A didn't work out and we're scrambling for something else.
I'd say one thing that I would just lastly on my side is ignore the yield curve to your peril. Like, if you are not understanding macro, and everyone will say, oh, I'm a stock guy, I'm a fundamental guy, total BS. You don't understand the macro dynamics that are happening and understand where liquidity is coming from, then you are going to lose badly at some point. And the smartest thing, we started a short-only credit fund in 2006. And the learnings we got from that helped us avoid the drawdown in 08, when we were actually up in 08 on the equity side and the credit side. You know, that if you ignore the yield curve, I don't care how good a stock picker you are, you're going to get smoked at some point.
That's great advice. Well, thank you so much, Doug. Really appreciate you helping out and the words of wisdom to the panelists. And we'll send it back to you, Kareem.
Thank you, Stephen. Doug, thank you for coming today, and hopefully we can talk later about some of the companies that you have that might be valuable for us at LinkedIn to look at.
Okay.
Thanks, guys. So Ariel, Cameron, and Alan, thank you for joining us today. I have to apologize in advance to Greg and JP, and I think Meg. We're running a little bit late. Hopefully you can still stay. If we're doing a really, really poor job, we apologize, but we're running a little bit late, so I hope you can still stay. Thank you.
Sure.
Thanks. Ariel?
Kareem, how are you?
Good. Cameron, how are you?
Can you guys hear me?
How are you? We're all happy to hear. So a very quick thing about Link2. It's all about balance, right? Link2, all about private, early stage.
Can you guys hear me?
Yes.
Okay, cool.
And identifying the next thing that's going to go public. And we thought we'd balance this presentations that you've so far heard with some young millennials who are in the public side. Got introduced to Cameron through Alan. Alan works with Link2 speaking from France right now in Europe. Cameron's up in Washington, I believe, and Ariel's in the middle of the US, right? So we've all got different time zones. So it's all about public investment strategies, what it looks like, what are your theses, what have you done, and what is some advice that you can give to our listeners? I'm not going to jump in with any questions. We're running really behind, so I'm just going to let you guys talk, and then going to shut you down, if you don't mind. At a certain point. All right,
Cool.
thanks.
Cool.
Cameron, why don't you start?
Yeah, so I guess a little bit about me. You know, I started trading about probably full-time about 4 years ago, right about 3.5, 4 years ago. And, you know, I generally just, you know, it didn't start off all sunshine and rainbows. I, you know, lost about half my net worth when I first started. And, you know, I basically had to figure out, you know, is this gambling or is this going to be me the rest of my life? And so, you know, when I was trying to figure that out, you know, in college, I didn't really enjoy it. You know, like I was telling Ariel, you know, my dad, he's an engineer, and, you know, my mom had her doctorate, and, you know, my brother worked in the FAA, and then here I am just, you know, at Green River Community College, just trying to figure out what I'm going to do with my life. And so, you know, with that, you know, going over that, I just felt like school wasn't for me. You know, I'd be in tutoring so much longer than anyone else, right? You know, and it felt like it wasn't really my passion. You know I can, when I put my mind to something in the past, whether it be like I'd play a little poker with my dad or play a little chess with my dad, but I put my mind on something, I'd work really hard at it, but there was a lot of things in school where I just felt like I was wasting my time. And, you know, and then over the past, you know, if I try and keep it short and sweet, over the past, you know, 3.5 years or so, you know, after I said I worked for Domino's Pizza, I was a delivery driver, and that's when I was like working overtime to make sure I could afford trading, because at the time, you know, trading was a losing game for me. Trading was not really fun. I mean, it was fun, but at the same time, when you start losing that kind of money, you start thinking about your future and where you're going to be and how you're going to put food on the table, and how you get, you know, I don't want to be the guy living at home and, you know, when I get out of college. It just was never going to be me. And so I just had to figure out ways to go about that. And so, you know, it took a lot of hard work and a lot of, you know, lessons being learned along the way. But now, you know, I'm basically a person who likes to motivate and inspire a lot of retail traders to take, you know, a small amount of money. What I'm known for is I took $1,000 and now I'm at about $17 million plus in 377 business days. So I try and inspire and motivate, and I've taken multiple $1,000 account challenges throughout. And, you know, Ariel is one of my, you know, a great friend and also a successful student. And he's actually in town. We're hanging out. First time we met in person.
Yep.
So it's been fun. But he's been crushing it. And I just try to give as much back as I can to the community to try and take away something from what I've learned along the way, because I like to tell people it's not that easy. And I've learned the hard way a lot of the time. But now, you know, I've put myself in a position to be able to inspire, to motivate, and also to teach people, you know, how I've gotten to where I'm at, and hopefully create, you know, a lot of successful students in the near future. So, yeah, that's basically a little bit about me. So, yeah. You want to go?
Yeah. So briefly, as Cam had mentioned, I actually had no experience in any of the capital markets prior to last year, April. And it wasn't until last year, April, which I actually found Cam on social media platforms. And you know, he has a chat room, which you know, a bunch of like-minded individuals get in there, share ideas. And you know, not that I didn't last year when I got involved into the market, you know, we had just had this insane correction because of COVID. And so a lot of people being locked up at home, you know, having lost their job, but then also the market having had such a giant correction, pretty much anything you had touched last year, you were going to make money on. So, you know, when I started to get my intro into the market, it seemed like people were really finding success trading. And I was like, okay, well, if all these other people can do it, why can't, you know, I? And, you know, having found Cam, having seen him go, when I found Cam, I want to say he was, you know, maybe about $600,000 from his $1,000 into his challenge. And so to kind of watch him, be at, I forget if it was like, it took him 109 days to go from 1,000 to 1 million. It's crazy. I know Cam's story because I followed him to the T, and I always thought to myself, if he can do it, he puts his pants on the exact same way I do. So why can't I? And so I got my intro into the market, and I actually started trading full time last year in June. And I just completed last month my first full year. And we've done just over $2.5 million since in about my first year, just over a year, really 14 months. So it's still it's still like a learning curve every single day. And just I'd say the biggest thing for new traders or anybody on the retail side, it's very important if you want to. It's very easy to say, okay, I've done some fundamental analysis on a great company, right? An Apple, have you? And, if I were to say, hey, look, we're looking 20 years down the road, Apple seems like a very stable and solid company, buy them, hold them. You don't necessarily care about the price, the current price, and because you've got a 20-year time horizon on your investment. But when you're a day trader, we're trying to take advantage of shorter time frames, smaller time frames. We're intraday, so we're not necessarily looking at 1 hour or daily charts, essentially. And I don't usually trade with the fundamental analysis because things move so quickly intraday. What I've come to learn is that the way things move and the way things set up for a second or a higher move is even more important than sometimes the news itself, because there are a lot of times in the market in which good news comes out, but there's been anticipation of the good news. Yeah. And so a stock actually sometimes makes that move before the news comes, and then on the day of the news, something sells off. And so, learning what a good price action looks like is for any of us millennial traders or even new traders, new day traders. Understanding what good price action looks like for me has always been the most important. And so, like I've told some friends before, if you're a weatherman and I were to say to you, hey, the weather in 1 month is going to be 89 degrees, partly sunny, with a chance of rain. Well, you don't really know, right? But if I